Hi, I'm Pattu from freefincal. Today, let's take a look at the Franklin US Feeder Fund. This is a fund of fund that invests in the Franklin US Opportunities Fund with the extension I account USD. So it's an institutional variant of the fund, and it's based in the Franklin Templeton Luxembourg office, which is in Europe. Luxembourg is a very small country in Europe. It's strange why they choose to do that instead of directly investing in a fund based in their US offices, which is strange. So just to be clear, you are going to put money in INR. They will take money from that for their expense ratio. Then they will convert it into USD. They will put it in the US Opportunities Fund, and the value of that fund will be declared as an NAV in INR. Please remember, the US Opportunities Fund will also have an additional expense ratio involved. So this Franklin US Opportunities Fund is an actively managed growth fund. It invests in US growth stocks across market capitalization, and it's labeled as a FlexiCap equity fund by Morningstar. It was launched in August 2004. Currently has an AUM of about $5.78 billion as on July 31st. And the total expense ratio of the underlying fund, that is the Franklin USD fund, is basically 0.85%. In addition, the feeder fund where you are investing is going to have a 0.63% for the direct plan, extraordinarily high 1.61% for the regular plan. I don't know why people would anyway put money via regular plan for such high expense ratios. It's for just a fund of fund. They're just going to put it in another fund. They're not going to do any research or anything. It's crazy to even give so much money as commissions to to an advisor just to get that. So, I mean, of course, what Franklin is doing is keeping the AUM within the family. They are basically giving it to their subsidiary and keeping it within the family by doing that. So the total expense ratio of the feeder fund is going to be about 1.47, 1.48% approximately, and this is 3 times more than the S&P 500 index fund from Motilal Oswal. I had talked about this in the ICICI US Blue Chip Equity Review. There also it's the same kind of ratio, and I had said that does it make sense to pay so much expense and invest when you have a low expensive option. I mean, earlier it was not available, but now at least new investors have it. Old investors should decide. So, because if you are going to pay so much money into expenses, then it better do a good job of regularly beating the fund. That's not happening in the case of both ICICI Blue Chip Equity as well as this fund, as we shall see. So the benchmark is Russell 3000 Growth Index. The Russell 3000 index is basically a whole market index. It covers mid cap, small cap, and large caps across the 98% of the US market caps with 3000 stocks. The S&P 500 only covers 80% of the US market, but it has got 500 large caps. So this has got 3000 all caps, I should say. And from that, about half of the funds with a better or I should say higher price to book ratio and higher forecasted growth rate is chosen as the Russell 3000 Growth Index. It's got about 1500 and I forgot how many are there now. Forgot the number of I think 1573 stocks or something like that. And I have mentioned the there it is. So it's got 1513 stocks, and its 5-year EPG growth rate is 19.77 with respect versus 12.62 for the base index Russell 3000. The PE of the index is 36.18 versus 24.97 for the base index. So they're basically investing in growth stocks with very low dividend yield. You can see the difference in the returns between the Russell 3000 and the Russell 3000 Growth Index over the last few years. And sometimes you can see here, for example, in 2016, the growth index only gave 7.4%, whereas the base index gave 12.7%. So sometimes the growth index can underperform the base index, so it doesn't always beat it. This is the since inception comparison of the Russell 3000 growth index, which is green. The red and the blue, which are kind of together, is basically the Russell 3000, which is black. Sorry, the red and the black. Let me say that again. Sorry, get confused. The green is Russell 3000 growth. The black is Russell 3000. The blue, which is right behind the black, I can't separate them, is the S&P 500. So there's not much of a difference between the S&P 500 and the Russell 3000. The Russell 3000 growth sometimes outperforms, and you can see the data there. I have also shown ETF data of the S&P 500 and the Russell 3000 from iShares. I don't know if somebody else has a ETF on the growth index. The growth index is basically like a factor index, I should say. So the US Opportunities Fund is benchmarked to the Russell 3000 growth index, and you can see here sometimes it has done very badly. See, for example, there's one more data here. Yeah. So from July 15th to July 16th, the fund fell by minus 7.2%, whereas the index moved up by 3.6% or so. Then sometimes it has underperformed, and very badly. Sometimes it has just managed to outperform. So although you are paying so much of money for the fund manager is not able to beat this factor based index, and that's a big problem. We are talking about USD. Forget about the feeder INR component. Even in USD, the fund is not able to consistently beat the benchmark. So that is a problem. And if you look at the fact sheet, you see all the same guys: Amazon, MasterCard, Visa, Apple. So it's a very tech heavy. Unfortunately, all the US indices basically are going to be like that. Market cap based indices are going to be tech heavy, at least that which has got some large cap component. So this is the performance of the three funds, of the three guys. The blue is the ICICI blue chip, the red is the Franklin feeder, the black is the S&P 500 total returns index in INR. You can see that up to the crash, both the funds have not been able to beat the S&P 500 since 2013 or so. Only for the last 6 months or so, after the recovery, the feeder fund has done well. But don't you look at that and invest. Please look at the past. Don't get carried away by these huge amounts in the last huge returns in the last few months and invest and get into trouble. It's just too expensive. It's not worth it. So if you look at the rolling returns here, the pink is the S&P 500 in INR, the brown is the feeder, the Franklin feeder, and the yellow is the ICICI US blue chip equity. Both of them have not been able to, more or less the Franklin feeder has been close to the S&P 500. That's all I would say. But please recognize that you're paying so much money for that kind of performance. It just makes no sense at all, I should say. Also, the Franklin feeder is significantly more volatile than the S&P 500, whereas the ICICI blue chip is less volatile than the S&P 500. I talked about this in that review. So that's a problem. So I would say that the fund from Motilal Oswal is better choice. That is, this S&P 500 index fund is any day a better choice than both the Franklin or Franklin feeder, US blue chip, and their own Nasdaq 100, either fund of fund or ETF. I would say it's a better choice because it's available now. I mean, those choices did not exist a year ago or something like that. But then there was no choice for you. You had to invest. But now you have new choices. Then you have to quickly adapt to the situation. I think it's better to invest in the S&P 500 if you want US equity exposure. If you know how to handle such exposure, how to manage your portfolio. If you are just in it for the returns, then that is immature. I will not say anything further. Fine. Bye-bye.